The case of SC BCR Leasing provides a useful review of the rules on self-supplies and an illustration of the fact that some member states have laws that appear to have been written by someone who didn't understand the directive. The basic charging provision in Article 14 of the Principal VAT Directive treats supplies for consideration as taxable transactions. A supply implies that there's someone else involved. The taxable person transfers goods to someone else and receives a payment in return. But there are special rules to add in other situations, mainly to prevent avoidance of VAT or abuse of the right to deduct it by a trader. Article 16 is a mandatory provision. All member states have to implement most of it as it stands. It covers the application by a taxable person of goods forming part of his business assets for his private use or for that of his staff, or their disposal free of charge, or more generally their application for purposes other than those of his business. The point is that application won't involve consideration, and if it's an application for non-business use by the trader, there isn't even a customer involved who's receiving the supply. The article requires that these events shall be treated as if they were a supply of goods for consideration, so output tax is due. But it imposes a condition which is the clue to the purpose of the law. It only applies whether VAT on those goods, or the component parts thereof, was wholly or partly deductible. So what it's for is to stop a taxable person buying things for the business and claiming back input tax on the purchase, and then doing something else with the goods instead. In effect, acting as a consumer, a person who ought to bear the cost of VAT, instead of a business which ought to be relieved of the cost of VAT. So the purpose of the provision is just to take back the VAT that was claimed when the goods were purchased. There are some exceptions, which again are mandatory for all member states. The application of goods for business use as samples or as gifts of small value shall not be treated as a supply of goods for consideration. What this means was considered a few years ago by the Court of Justice in the EMI Group case. It's for a member state to determine what is a gift of small value, but the court explained what will be regarded as a business sample. The effect of that is that the business is entitled to recover input tax on the purchase and doesn't have to account for any output tax on what happens to those goods, because there's no actual supply for consideration and no deemed supply under Article 16. The input is in reality a general cost of the business, so the input tax ought to be deductible. That's most obvious in the case of samples, where you give away one in the hope of selling 100. So there will be output tax elsewhere on the other transactions. Article 18, by contrast, is an optional provision. It says member states may treat each of the following transactions as a supply of goods for consideration. It applies where goods are applied for business purposes, but the taxable person wouldn't have been able to deduct input tax on the purchase of those goods because the business use is for making exempt or partly exempt supplies, or else is applied for a non-business activity of a taxable person who claimed input tax on the original expense because it was at the time intended for a business purpose. This covers a range of possible types of goods, the common theme being that they come from within the business. Goods produced, constructed, extracted, processed, purchased or imported in the course of the trader's business. The point is that VAT is not supposed to create advantages and disadvantages. If someone would suffer irrecoverable VAT on buying something from someone else, it might be cheaper to make the thing in-house, employing people whose salaries aren't VATable to save the costs associated with a purchase. It can be complicated to police such a rule, which is one reason it's optional for member states to implement or not. They are likely to define specific areas in which it applies, rather than making it a completely general principle. The way it works is that the trader will be deemed to make a wholly taxable supply when the goods are applied for the stated purpose. Any input tax incurred on external costs up to that point is fully recoverable. Output tax on the deemed supply has to be paid to the authorities, and it can then be recovered only to the extent that the business can recover VAT on that sort of application. If non-VATable inputs such as salaries have been used to create the item, the output tax charge on the self-supply will be larger than the input tax recovered on the external costs. For completeness, I'll just mention that Article 18C imposes a self-supply charge when a trader ceases to be a taxable person. Where goods are still held on which input tax was recovered, they're effectively going to be applied to private or non-business purposes after the taxable activity has ceased. So there's the possibility of a self-supply charge at that point to prevent that VAT disappearing from the system. The case of SC BCR Leasing, case C438 of 13, is about a Romanian finance leasing company that purchased cars and recovered the input tax on the purchase. It then leased them to customers, charging output tax on the rental income. This appears not to be the same as the GMAC business that is covered in a different lecture, in that this is about continuing rentals, where the output tax will only be accounted for month by month as the income falls due. So to start with, there's a big recovery of input tax on the purchase of a car, and it's only after most of the lease term is completed that the output tax will exceed the input tax. The company terminated several finance leasing contracts because the customer paid late or didn't pay at all. Sometimes the customer refused to return the car. That would mean that there would be more input tax than output tax, which the Romanian authorities weren't happy about. It's not clear whether they may have suspected that there was a VAT avoidance motive. If you set up a finance lease and then deliberately let your friend keep the car without paying, I can see that the authorities would have good reason to be upset. But if it's just the hazards of trade, it seems a bit harsh for the authorities to try to punish the trader for making a loss. What they wanted to do was to charge output tax on a deemed supply on the termination of the lease, so there would be output tax to cover all the input tax. But to require the trader to pay output tax, they had to have a charging provision. There wasn't a supply for a consideration, so it would have to be Article 16 or Article 18. The court noted that there was no possibility of application for private use by the taxpayer because the goods were not in the possession or power of the taxpayer. As a result, the failure to recover the vehicles couldn't be treated either as a self-supply under Article 16 of the Principal VAT Directive or an internal supply under Article 18. The situation simply didn't fit any of the descriptions in the law. There was an unusual further aspect of the judgment. Normally, the Court of Justice only answers the question set, which sometimes means that it's hard to see the consequence and may lead to more questions having to be asked later. In this case, the Court added a brief further comment, in order that the referring court may be provided with a helpful answer. I think that the comment is in fact too brief to be really helpful, but this is what they said. An adjustment of deduction of input tax could be required under Article 184 to 186. The implication was that if the member state thought that it was wrong to allow more input tax to be deducted than output tax was accounted for, then they should look to get some of the input tax back, rather than trying to account for output tax. But can they? Article 184 simply says that the initial deduction shall be adjusted where it is higher or lower than that to which the taxable person was entitled, but it doesn't explain why that might be. Article 185 goes on to give some examples, where, after the VAT return is made, some change occurs in the factors used to determine the amount to be deducted, for example, where purchases are cancelled or price reductions are obtained. But no adjustment should be made in the case of transactions remaining totally or partially unpaid, or in the case of destruction, loss or theft of property duly proved or confirmed, or in the case of goods reserved for the purpose of making gifts of small value or of giving samples. None of that seems to be relevant here. It seems rather to be about adjustments made to the purchase, in particular the purchase price, rather than about what happened to the goods later. The case will be sent back from the Court of Justice to the Romanian court. Without quite a lot of further investigation, and possibly employing a translator, I'll never know what use the Romanian courts made of the Court of Justice's helpful suggestion about input tax.